Hello, everyone. Thank you for joining us today. Good afternoon or good morning, depending on where you're joining us from. My name is Tom Mao. I'm the Strategic Tax Director here at Stanbaugh Nest. Joining me on today's presentation are Jen Nelson, the Managing Director of our overall tax practice, as well as Kelly Morningstar, another director in our Strategic Tax Group. And the topic of the day today is how to utilize the R&D tax credit in your year-end planning. Some of you I know were with us last week when we did an overall tax planning session. Today we're going to get pretty specific on the role of the R&D credit in that planning. Before we get started though, as always, we have a little bit of housekeeping to take care of. If you would like to customize the look on your screen, you can do that just going into the GoToWebinar screen viewer. You can make that screen larger or smaller and minimize our faces as well if you like. We will keep everyone muted throughout the session. If you do have any questions though, please ask them. Use the questions tab in the GoToWebinar panel. I'm not sure if we'll have time to answer those live today. We do have a lot of material to cover. But if not, we will respond to each of you with your questions. So please drop them in there and we will get back in touch with you. If you're having any trouble with the audio, you can toggle back and forth between your computer audio or in the GoToWebinar panel, there is a dial-in number. Sometimes because of bandwidth and such, the computer audio is a little choppy. You may have better luck if you use the phone audio on that. We will have a survey at the end of the meeting. We would appreciate if you would fill that out. That helps us in planning our future webinars. It's also just the one more chance for you to give us your feedback or ask questions if there's anything that you think of after the fact. And again, as I said, we'll get back to you on that. There will be 3 polling questions today throughout the session. We do ask that you answer those. We need about 85% of the participants to answer for us to move on. And the purpose of those polling questions is to allow those of you that need it to get your continuing education credits. They're simple questions, so please just drop those answers in there when they come up. And as we always do, our disclaimer, because taxes are such a moving target right now, is that the information we're about to present today is current as of today. We can't guarantee with everything that's going on in Congress and such that it won't change after the fact. But if it does, we'll be on top of that and we'll be back to give you updates on that. So moving forward, what we're going to cover today is, after I'm done here with the introduction, Kelly Morningstar is going to jump in. We're not going to get real deep into what the R&D credit mechanics are, because we know we've done that in many other webinars. But just as a refresher, Kelly will give you some background on the credit and what it takes, especially for architecture and engineering firms, to qualify for the credit. Then Jen's going to jump in. She's going to talk about overall tax planning strategies, so things that you may be considering year in, year out in your planning. What's out there in the current landscape, what we're hearing about potential tax legislation, and where the R&D credit fits into that. Then I'm going to come back on and get a little bit more specific with some comments, first directed for C corporations, and then in turn also for pass-through entities such as S corporations, partnerships, and sole proprietorships. To wrap it up, then Jen's going to talk about some other provisions and things we're seeing in the R&D landscape, things to kind of beware of, things that could be on the horizon, and then we'll wrap it up. And if we do have time for any questions, we'll deal with them then. So what are we seeing currently in the R&D landscape? Well, regardless of where the tax rates go, we do think that the credit should play, if you do qualify for it, should always play a part in your tax planning strategy. It's a credit for money you've already spent. As Kelly will go over, the biggest driver to the R&D credit is your labor cost. Your labor cost typically in your design work. So that's money you've already spent. It's money you're going to continue to spend. So why not go ahead and take advantage of that and get some tax benefit from that? We typically, and it's always dangerous to give averages because every situation can be unique, but on average, we see about 8% or more of your qualifying expenditures turning into credits. And remember again, a credit is a dollar for dollar reduction of your tax. We sometimes throw these terms credit and deductions around almost as if they're one and the same, but a credit does carry more value to you than a deduction, because a deduction saves you at your applicable tax rate. So if you're in the 25% tax rate, a dollar Deduction saves you a quarter, but $1 of credit saves you $1. Just to remember, we had some significant tax law change back in 2015, something called the Protecting Americans from Tax Hike Act, and that's really what opened the door for many firms to start taking advantage of the R&D credit. It did a couple of things. It made the credit permanent, a permanent part of the tax code. Internal Revenue Code 41 has been around since 1981, but for those first 35 years or so, it was a temporary part of the code. Now, that just meant Congress needed to renew the credit periodically whenever it expired. And that actually, to some degree, worked out to our benefit because it continued to expand the scope of the credit. But I think we were all happy to see it become permanent in 2015, knowing that now the only way the credit can go away would be through a tax act where Congress and the president took, legislative action to eliminate the credit. We certainly don't see that happening in today's environment. COVID brought that to light that, here in the U.S., we have a lot of dependence on foreign suppliers, and there's a lot of movement to rectify that situation. Get a lot of productivity back on U.S. soil, and the credit can be a great way to incentivize firms to do that. The other big thing that happened with that 2015 Act, for those of you that do operate as pass-through entities, S corporations, partnerships, and such, if you fall into what the IRS's definition is of a small and medium-sized firm, and that's pretty liberal interpretation, if you ask me, because they define it as a firm with $50 million a year or less in average receipts. So to me, that's actually a fairly good-sized firm. If you fit in that category of $50 million or less, when that credit passes through to your owners, they can use it versus their ordinary tax liability or the alternative minimum tax if they're subject to that. Now, an explanation, deep dive into the alternative minimum tax is I think, beyond the scope of our webinar here today. But just know that as we went across the early years of the 2000s, we saw more and more people get caught in the AMT. And if I were to, look at the individual tax returns of many of you that are owners, I would venture to say probably a lot of you do pay at the alternative minimum tax rates. Prior to 2016, you couldn't use the R&D credit against that. Now that you can, it's kind of really opened up the door for us there. If you're a startup entity, there were some provisions that said if you're not making profits yet, you don't have income taxes as a result of your entity, we can actually use the credit versus your payroll tax liability. So a real nice benefit there to get you off the ground. We do have the ability to carry back 1 year, carry over 20 years of credit, and I'm going to talk about that a little bit more when we get into some of the specific comments. So even though, these rules changed, it's hard to believe 6 years ago, I think every day we still talk to firms. I think Kelly and I have 2 calls with 2 firms today who haven't used the credit yet and are just learning about it. So if you haven't used the credit yet, don't feel that you're unusual in that. We are finding firms just starting to take advantage of the credit almost on a daily basis, and we have some solutions there to maybe maximize what you can do to even capture some of those back credits. So that's a little bit of setting the stage for what we're going to go over today. But before we get too deep into it, just to know who we're talking to, we are going to start with our first poll question. And that's a pretty simple one, just to ask you if your firm has used the R&D credit in the past, just a yes or no on that. So Kelly, if you can launch that, and once we get enough responses here, we'll share the results.
Sure thing, Tom. That poll is open. So we need about an 85% participation or a minute elapsed to move on. And we've reached 86%. So I'll give everybody a couple more seconds and then I'll go ahead and close and share the results. Alrighty, it looks like our crowd says 59% yes, they have taken advantage of the R&D tax credit in the past, and 41% have not.
Okay, well, thank you, Kelly. That's a nice mix there for us. folks that are going to have a little bit more familiarity than others, but as I said, Kelly will go through some background on the credit. Maybe even if you are taking advantage of the credit, you'll pick up something that you weren't aware of with that. And that'll set the stage for all of us on how we can maybe better take advantage of the credit in our planning. So with that, I'm going to turn it over to Kelly.
Thanks, Tom. Again, my name is Kelly Morningstar, and I'm a director in our strategic tax group. I'm going to do a high-level overview of the R&D credit, and mainly I'm going to speak about the four-part test. So in order for a project to qualify for the R&D tax credit, the project has to satisfy this four-part test. It has to be technological in nature, there has to be a process of experimentation, an elimination of uncertainty, and then the project has to have a permitted purpose. So in a little bit deeper dive for each part, the technological in nature. So this is the process of experimentation used to discover information, relies on the physical science, biological sciences, engineering, computer sciences, chemistry, those type of activities. It does not include any soft sciences such as social researches, arts and humanities. Those type of activities would not qualify as a hard science according to the IRS. The next test is there has to be a process of experimentation, and what that is a methodical plan that involves a series of trials to test a hypothesis, analyze the data, refine that hypothesis, and retest the hypothesis. Some examples of this include, the evaluation of several design alternatives, computer modeling, design iterations, assessment of design alternatives, or energy sources or mechanical systems or whatever you're doing your design for. This is that back and forth, that trial and error. You're working on refining the design to make sure it can meet your client's needs, regulatory needs, all those different factors that are impacting the final design choices. It's that back and forth. And you'll find the common activity of this in your preliminary design phases, your schematic design phases, the design document, and the construction document type phases of projects. The next test is there has to be an element of uncertainty. So at the outset of the project, there was some type of technical uncertainty, whether it would be your capability, the methodology, what the final form is going to look like. How are we going to do it? What's the design going to look like? What's each little detail going to be? What system are we going to choose? What building material is going to be needed? What type of foundation is the project going to have? So it's helping to the business component is intended to discover this information that would eliminate the uncertainty concerning the development of this product or process or whatever your project is. So then the final test is a permitted purpose. So what I tell clients is, why were you hired to do this job? Is it a new or improved product or design that increases the function or performance, the reliability, the quality, creates efficiencies of the new design or an internal process or a new product or new manufacturing process? Anything related to style or taste or cosmetic would not qualify. So it's just identifying what are you developing or improving, and it doesn't have to be new or improved to the industry or as a whole. It just has to be new or improved for that project, for that client. So once you identify you have qualifying activities, how does that translate to calculating a credit? So with the credit calculation, you have to identify your qualified expenditures, or you'll hear them called QREs. And as Tom kind of alluded to earlier, the main bucket of the QREs is wages. It's money you've already spent. You take your W-2, the box 1 W-2 wages, and calculate a percentage of employees' qualifying time and multiply that. The IRS has a nice rule that says if your percentage of qualifying time is 80% or greater, then you actually get to take 100% of your box 1 wages. So that's a nice little bump that the IRS gives out. Um, you can also look at 3 levels of what they call research. Those providing the direct research, those providing direct supervision of the research, and those providing direct support of the research. So you can also look to who else is assisting on the projects as well. And typically we find that this makes up the largest component for most companies. You can also look at qualifying supply cost. Now with qualifying supplies, it is something that has to be consumed or destroyed during the R&D process. It cannot be your computers or software or anything like that, paper. If you're creating a prototype or a widget or something and you're testing it and it gets destroyed during the R&D process, then those materials would qualify. Or if you're doing some kind of like 3D modeling and testing it as well, potentially those costs could qualify. The final bucket of qualified research expenditures is what they call research, or what we like to say is subcontractor cost. So you're allowed to take 65% of eligible fees for subcontractors. Now, with subcontractors, there's higher thresholds you have to look at. You can't just take your subcontractor costs and multiply it by 65% and call it a day. They have to make sure that they are eligible cost, and we also have to look at who bears the financial risk as well as who retains the substantial rights to the research as well for it in order to qualify. So there are additional things you would have to look at in order to claim subcontractor cost. Which is nice is that you do not have to have qualified expenditures in each of the 3 buckets. You can have one and be perfectly fine to claim the credit on just that. And then how the credit is computed, there's 2 different methods to calculate a credit. There's the regular credit method and the alternative simplified credit method. The regular credit method, you have to establish a base period from either 1984 to 1988 or your first years starting up as a business. We find that a lot of companies do not claim a regular credit method just because, if you were around a business in 1984 to 1988, typically you don't have records well enough to establish qualifying expenditures for that many years ago. So we see a lot of clients choose to take the alternative simplified credit. And with that, you take your current year qualifying research expenditures, so what we determine as wages and qualifying supply cost or subcontractor costs as well. And it's the current year of the total of those costs over the average of the prior 3 years. So you have that base period amount there you have to establish as well. And now we're going to take it over to Jen for some traditional tax planning strategies.
Thank you, Kelly. So we get to turn it back over to me to talk big picture strategies as far as tax is concerned. So, and that that goes hand in hand with my role here at Sanborn Ness. I'm the Managing Director of Tax Services here. So you would end up talking to me if you had any type of tax issues, and I can get you in the area where you need to be. But let's talk a little bit here just about some traditional tax planning strategies and how we can utilize those under the current tax landscape. So, as I always say, when I'm having tax planning meetings, when we're talking to people about what can we do to reduce our taxable income, well, the name of the game for tax planning is defer, defer, defer. For the most part, anything that we talk about, you're deferring income into the future, you're accelerating expenses into the current year, and this, remember, assumes a stable tax rate. So in a time when our tax rates are remaining the same year over year, we're going to just keep kicking that can down the road, pushing that income into further years, and pulling expenses into the current year. And again, a lot of people say to me, well, you're still going to have to pay it someday. Well, yes, but it all goes along with the time value of money. And do you really want to pay now? Let's just keep kicking it down the road because you can do more with that money that you have now instead of pay the government. So, deferring income, accelerating those expenses. But when we do that, So we're holding off on billing or collecting cash in the door, and then we're paying out as many expenses as we can. You really need to consider that negative impact on cash flow. So we often find where you can only do so much because you just don't want to drain your cash down to nothing or even worse. And then perhaps you still can't get down to not paying taxes. Then you have a tax bill due, or you have payroll due at the first of the year. So it really becomes a big balance game, a balancing act when it comes to what you need to do here. Along with those accelerating expenses, we can accelerate depreciation. So we can take advantage of the rules put into place by the most recent tax legislation with bonus depreciation, which you can take 100% of a write-off on certain assets that you put into place. Now remember, that starts declining in the next couple of years in the absence of different tax legislation, which we think will happen at some point here. But as it stands right now, the accelerated depreciation in terms of bonus will start diminishing here in a few years. But with depreciation, you can also partake of something called a cost segregation study, where if you're moving into a new building, or you built a new building, or you have a building on the books at 39-year property and you're just depreciating ratably over that 39 years, you can take a look at that and have a study done where a certified engineer will look at that, and maybe some of the building is in a shorter life if it's related to equipment rooms or just different shorter life properties. So that's something you can do to accelerate expenses. But again, that's just kicking a can down the road till later. It's not necessarily a permanent change. Section 179D, energy efficiency deductions. Again, that's a deduction. So in the current year, if you qualify, if you're putting, if you're buying a building or you're performing work on a governmental agency and can get that certification letter, you can get this Section 179D energy efficiency deductions. And both of these are things that, by all means, reach out to us and we'll be happy to talk more about those as well. Some other traditional tax planning strategies, Section 199A is that 20% pass-through deduction. So we'll go out of our way to try to maximize that benefit for the shareholders and pass-through members of businesses. Cash basis accounting is a big one. A lot of service industries are on cash basis accounting, but every once in a while we'll take a look at somebody's tax return coming into us, and they'll be on the accrual basis of accounting for tax, and we'll switch them over to cash, provided that we can. And it provides a big tax savings typically in the current year, as well as cash basis taxpayers. It makes it easier to plan for the future. So again, that goes back to my prior page, where if you're a cash basis taxpayer, you're deferring income out, you're paying out as much as you can, and you're really looking at that that cash balance to see where you are at year end as far as taxable income is concerned. There are some other accounting method changes for tax purposes that we can utilize as well, and those are pretty straightforward and typically used with accrual basis taxpayers. But we can look into prepaid expense and recurring item exceptions. So those are all things that we would utilize to lower tax in certain years. And again, remember, all deduction related. So nothing that's a permanent deduction or a permanent effect. It's all just pushing that tax burden out to the future. Sometimes we are able to do some projections and modeling to say, okay, so this year our tax is really high, but it's not going to be next year, so maybe we want to do something a little differently. Or this year we don't have as much tax, so maybe we should save switching over to cash basis next year, or making some of those accounting method changes, or doing that cost seg study next year. So there are ways to plan from a timing purpose to get your maximum benefit from those tax planning strategies. The other thing I would mention there is we're really keeping a close eye on potential tax legislation right now. The whole increase in rates has been bandied about. We're not seeing that much now, but who knows what actually will be in the final bills when they come out, because as I understand it, the vote has been delayed on the tax piece because it's going back to make sure that there's enough revenue in there to cover the infrastructure bill. So, you put in they put in place a lot of these social programs and giveaways, and then it has to come from somewhere else. So they're just making sure that works. So while the rate changes that we had originally seen, like people's individual rates going up, are off the table, who knows if that's something that's going to happen. So typically in years like this, where there's a lot of uncertainty as to the future and tax rate changes, tax law changes, like I said, we do like to run different scenarios to double check and see what makes sense and be prepared for whatever happens. Because inevitably we will find out about a tax law change the week between Christmas and New Year's. That seems to be always how it works. So everything I've talked about, though, has been running different scenarios, looking at deductions, looking at when to maximize from a timing perspective. When we talk about credits, however, credits permanently reduce tax. So that is why we put so much focus on the research and development tax credit. I have a couple others listed here, the work opportunity tax credit. That one can be quite large for some people, but that's a specialized credit that can be used on the return. Employee retention tax credit, that has been big news this year for 2021 and 2020. That was it's a short-lived credit, very nice from a payroll tax standpoint, but injecting cash back into businesses. But remember, if you're maximizing that for 2021, you are potentially adding the amount of the credit of income back to your taxable income. So that's why all of this planning needs to happen, to make sure that we're taking that into consideration. We really have to look at the interplay between the employee retention tax credit. Now, the R&D tax credit can be impacted by that employee retention tax credit as well, though the wages that we utilize in the calculation of the credit are impacted. So it could reduce the amount of credit, but again, remember, maximize that R&D credit, because that is a dollar for dollar savings against taxes. It is not a deduction. It's not something that's going to reverse in later years. It's a dollar for dollar deduction, or a dollar for dollar offset against taxes in the current year. So we always say, when you're tax planning, make sure that you are first looking at your taxable income. We need to add back anything from the employee retention tax credit and any other credits that you might have taken, and then look at your R&D and maximize that R&D. And then from there, we start taking all of the other options. So I started talking a little about this. So the key tax proposals, while I talked a little about rates and we're not sure what's going on there, the one thing that has stuck around is the expansion of the scope of the net investment income tax. That's the NIIT. It came into effect back when President Obama was in office, and it's that 3.8% tax on investment income. Up until this point, pass-through entities were immune to this tax because they're active trade or business income. But the talk of the town now, and what's in those proposals, is that that 3.8% could potentially be applied to pass-through business income. So anything passing through from an S-corp, partnership, any pass-through entities, which might not sound like a lot, 3.8%, but if you're passing through a decent amount of income, that's just another 3.8% of taxes that you would have to pay. Where we see that it will really impact individuals is that potential sale of a business, or in the past it's been it's been widely known that an S Corp was better than a C Corp for selling, and I'm probably dipping into Tom's part here, and I apologize, so I won't say much. I'll let him do most of the talking there, but this has the potential to really impact S corporations from a standpoint of if you're planning to get out of those when this is in effect. There's also talk of that new surcharge on high-income individuals, estates, and trusts. Nobody really understands that yet, what that will entail. I think we just have to wait to see until the final bill comes out. But like I said, we're planning for multiple things here and trying to anticipate some things that we think could happen. So from there, I say, is it time for reverse planning? Well, we're not really sure. If we go on to the next page, we look at everybody individually. Every taxpayer is unique. This is such a fluid situation, like I mentioned. We feel like, yes, this is current as of today, but every day I keep seeing new thoughts and ideas and why they're delaying the vote today, and which senator is saying this and which representative is saying this. So remember, it's a very fluid situation. Everybody's situation is unique. Your situation is unique. This year, it might not even matter, but we talk about this reverse planning, and we talk about, does it make sense to keep some of that income this year? Because we know taxes really have nowhere to go but up in the future. With the past year and a half and everything that's happened, the massive social funding due to COVID and the spending due to COVID and this new Infrastructure Act, we just know that it's going to have to be paid for somehow. So we believe very strongly that most of our clients are going to be impacted by this. So we're really taking a look at, here's how things are if nothing changes, here's how things are if rates go up in the future, which again, not saying that they will, but they could, or if these other things take effect. And really, what do we want to do here from that? So do we want to keep some of that income in here and let it fly, and then next year have a smaller amount? And some of these provisions are going to be sunsetting that were put into place by the Tax Cuts and Jobs Act under Trump. Some of those are going to be expiring soon. So it still might make sense to do some of that reverse planning. There's such a long-term impact from this. I think we have to consider all variables. And then finally, we keep talking about, does this impact our decision for what type of entity we want to be? Are we a C Corp right now, and do we want to switch to an S Corp? Or are we an S Corp, and do we want to go back to a C Corp because the C Corp rate is lower, but we don't see the individual rate getting any better, and let's layer in the net investment income tax to that S Corp. And I think Tom will hit on that again in a couple slides from now with the C Corp versus the pass-through entity. So I think, there's a lot of things to consider here, which is why this time of year we keep saying is really, it's critical to be taking the time from now until the end of the year and looking at all of these situations as we move forward, and just trying to get a handle on, okay, this is how it is right now. This is how it could be. This is how it could be B. This is how it could be C. Again, it's up to you and your risk tolerance. And some people might just say, well, let the chips fall where they may. But I don't know about you. I like to be a little in the know, and I'm a planner. So I just try to get ahead of these things and try to understand how all of these different things can come together and impact me in the future. So with that, that's really my piece on the tax planning strategies from a traditional standpoint and how we think things are going to move forward into the future. I'm going to hit on a polling question here. So I'll read it out. How is your company structured for tax purposes? Are you a C corporation, S corporation, partnership, sole proprietorship, or other? I'll hand it over to you, Kaylee.
Alrighty, so the poll is out there and launched. We're looking for 84% or 85%, participation, or if 60 seconds elapse. And about 80% of the crowd has already voted, so everybody's with us this afternoon and alert, which is all good things. Just need a few more people to raise their hands and cast their votes here. All righty. I'm going to go ahead and close and share the results as we reached 85%. And it looks like 27% are C Corporation, 61% are S Corporation, 7% are partnership, and sole proprietorship and other tie at 3%.
All right. Thank you so much. I am going to now turn it back over to Tom to talk a little more about C Corps and pass-through entities.
Okay, well, thank you, Jen, and thank you, Kaylee. And interesting results there on the poll. It sounds like the majority of the folks out there are S corporations. But I would encourage you to maybe pay attention to the comments on the C corporation as well. As Jen said, the trend, boy, for almost as long as I've been in this business, has been to push people towards the S corporation, away from the C corporation for many, many good reasons. In fact, back in 2018, when the Tax Cut and Jobs Act came into play and it lowered that corporate rate down to 21% across the board, which for many of you in the architecture and engineering industry, if you had been C corporations before, it was as high as 35%. We thought, wow, with a reduction like that, maybe that pushes us away from S corporations to C corporations. But for many reasons, we analyzed that with a lot of firms, and that still kind of looked good to us. Well, now there's some other new things on the horizon that Jen talked about, and I'll get into. That I'm not saying we should go S to C, but I'm saying we should think about that. But what I really want to concentrate on today, though, is talking about whether you are a C corporation or an S corporation, a partnership, or what have you, how the R&D tax credit interplays with everything Jen just walked us through. Jen went through many of those traditional tax planning strategies that every company, for the most part, goes through every year to try to get that tax bill to as low as it can be. And when we talk about C corporations, that's lowering the tax bill at the entity level, at the corporation level. And when we talk about S corporations, it's getting the taxable income passed through to our owners down so they don't have to pay as much tax at the individual level. Well, doing that has some other maybe unintended consequences sometimes. And how can the R&D tax credit kind of weigh that and help us with that and give us an even better position? So let's start by talking about C corporations. As you all know, as I mentioned, the C corporation tax rate right now is a flat 21%. Almost back to the beginning of last year's presidential campaign, we certainly expected that then candidate and now President Biden was going to drive that rate higher. We heard it could go back up as high as that old 35% rate that was in prior. Then we heard it tempered to somewhere between 26.5% to 28%. But we were also hearing that rates were going to go up on the individual side. Well, now we're not so sure about that. The latest draft we heard of the Build Back Better Act, which was released on October 28th, does not have any rate increases at either the C corporation or the S corporation level. It does have these other items that Jen talked about. The net investment income tax, which would not hit C corporations, it would hit S corporations and partnerships, and then that whole that surtax situation as well, which again hits individuals, not corporations. So we don't know if that act's going to pass. Every day we hear that, as Jen mentioned, Senator Manchin is talking about we're not going to allow more spending. Senator Sinema says no more taxes. But I think we know one thing for sure, the tax rates are not going to go down. We're just not sure how much they're going to go up. And as it stands today, that 21% C corporation rate, that looks pretty attractive at the federal level. Now, the problem we have there, obviously, is if we want to get that money out to our owners, then it's taxable to them as dividends. So the real tax rate is more than 21% if we bring that out. So what have we traditionally done in a C corporation to avoid that double taxation? Well, typically, we try to make every bit of taxable income go away at year end. If we're cash basis, We pay every account payable that we possibly can. We defer bringing income in. We may delay our billing. We may pay bonuses out. We may do a whole lot of things. And that's very successful in avoiding income taxes. But what does it do? It takes an awful lot of cash off of our books. And then you may run into a problem with you have to give financial statements to your bank, and the bank doesn't like the fact that you didn't show any profits or didn't build any equity on the books. So how can we avoid that? Well, how about we take advantage of the R&D tax credit to its maximum? My example here says if I have a $50,000 credit, and a $50,000 credit is not unusual for us to find for a firm of even moderate size, and maybe, I don't know, $5 million to $10 million firm, often we can generate a $50,000 credit or more. Well, if you do the reverse math, if you do the reciprocal of 21%, $50,000 will cover $238,000 of taxable income. That's a lot of cash that we can keep on the books and still not pay any taxes and have a much stronger looking balance sheet. So many times when we introduce the R&D credit to C corporations, the response we get is, well, we don't need this credit. We don't pay any taxes. And I guess what we're saying is, well, no, you're not paying any taxes, but you're going to great lengths and costing yourself some cash to get there. This is, as we've said a couple of times, a credit for money you already spent on qualifying labor in your design phase. You've already earned this credit, take advantage of it. Now, again, a lot of times we walk into that firm and we may be looking at 2021 and saying, let's put this strategy in place. But they're saying, but, in past years, we didn't pay any tax. We don't need it. Well, we are allowed to go back with the credit for as many years as are still open under statute. Generally, that's 3 years from the date you filed your tax return. So without going into the intricacies of that calculation, that means for the most part, your 2018, your 2019, your 2020 tax years are still open to change. Meaning we can go back and figure out what your credit would have been in those years, file an amended tax return, and claim that credit. And even if you didn't have any taxes paid in those years, we can carry that credit forward to be used in the future. The R&D credit is not a refundable credit, which means you can't get a refund over and above what your tax liability is. The employee retention tax credit that many of you maybe utilized in this past year is a refundable credit. As you know, that's a credit taken on your payroll tax returns, but you can get a refund greater than your payroll tax liability. Incredibly good deal. But as Jen said, remember, if you did use that employee retention tax credit as a payroll tax credit, and let's say you got a $100,000 credit there, that's great. That's $100,000 cash in pocket. But that $100,000 will be taxable to you on your income tax return. So again, if you're in a 25% tax bracket, you're going to give $25,000 of that $100,000 back and net $75,000. Well, maybe we could offset that additional $100,000 of taxable income from the employee retention tax credit, offset that tax with credit from the research and development tax credit. That's where we really encourage you to work with a provider who's knowledgeable in all the different aspects so you can get the best bang for the buck overall. Remember, wages that you used for your PPP forgiveness loan can't be used for your employee retention tax credit, and then the wages you use for your employee retention tax credit can't be used for your R&D tax credit. So it's a bit of a juggling act there. It gets even more complicated if you have a certified FAR overhead rate for governmental contracts, and we can't forget about the impact on state and local taxes too. But we work with many firms to try to maximize that benefit in its totality. And remember, if we have to take a haircut on the R&D credit in 2021 because we're maximizing these other short-lived benefits like the employee retention tax credit, that makes our qualifying cost for R&D lower in 2021, which will come back to benefit us in the next 3 years because, as Kelly explained, the credit is based on your current year expenditures as compared to 50% of the average of those for the prior 3 years. So if we have a low year here, and maybe you're not happy that, man, I've been used to getting an R&D credit of this amount each year, and you're telling me it fell off the table a little bit in 2021, well, that's generally because you're gaining benefits somewhere else that you wouldn't have had, and you won't have in the future because these provisions expire. So we think R&D still plays a huge role in your 2021 planning. And even if you have to take a little haircut this year, you'll see that come back again 3 times over in utilizing that lower year in your base period into the future. Also remember that if you were able to use the second round of PPP this year, if you were able to use the employee retention tax credit, just by definition, that means your revenue was lower in 2021 than it was in 2019. So most likely your labor went down as well, and this credit is based on the labor. So that question has come up to us a lot. Why is my credit lower this year? Well, part of it is, the COVID-related impact, and part of it is we've got other benefits out there that we just don't normally have. My last bullet point on this slide talks about offset big tax of converting to an S corp. But what is big tax? Big stands for the built-in gains tax, and it means that if you are an S corporation, you're moving to C corp, or I'm sorry, if you're If you are a C corporation and you are moving to S corporation, there is a tax that you have to pay on the difference between the fair market value of your assets and their tax book carrying value. Well, remember, if you're cash basis, your tax value for your accounts receivable, your work in process is 0. You haven't paid tax on that till you collect the money. But there is a fair market value to that. Your client owes you that money. So a lot of times this precludes people from moving to S corp because it's a one-time hit in taxes. Well, the good news is if we have unused C corporation R&D tax credits, we've planned away that taxable income over the years. We can use that carryover of those R&D credits against the building gains tax. So again, I know I just talked about we may see a movement from S to C rather than C to S, but we'll be monitoring that. As Jen said, each situation is unique. And if it does make sense for you to go C to S, we might have a way to offset that tax cost. So now let's go to the pass-through entities. The S corporations, the partnerships, the sole proprietorships. Here, of course, these entities don't pay tax at the entity level. They calculate their taxable income. They pass it through proportionately to the underlying owners. My slide says shareholder, but that could say partner or sole proprietor as well. And they pay tax at the individual level, at their individual tax rates on that. Well, the R&D credit passes through ratably as well. So again, we calculate that R&D credit at the entity level. We pass it out to the individuals. As I mentioned before, if the underlying firm is $50 million a year and less in receipts, no limitations from the alternative minimum tax in taking that credit on the individual tax returns. Now, again, sometimes we hear from people, well, I don't think it would work for me because I didn't have that much income coming from my S corporation. My taxable income was, close to 0 or even lost money. The thing a lot of people overlook is you can also utilize the R&D tax credit against any taxes that are generated by paying the owner a salary. Now, Jan had mentioned briefly the Section 179D deduction. That's a deduction for constructing energy efficient property. It usually goes to the building owner. But in the case of when that building owner is a governmental agency, they can push that deduction through to the designer of record. So a lot of times we see a really, really nice windfall benefit come through to the architect, the mechanical electrical engineer, the structural engineer, whoever was involved in the design of that energy efficiency property. And we've seen firms utilize the 179D to basically make all their entity level income go away. And again, they think, well, I use 179D. I don't have to worry about the R&D credit. I don't have any taxes coming from my entity. Well, if you are paying that owner a salary, the R&D credit can play a role there as well. Let the 179D take away the business income that comes through on the Schedule K-1 to you, and let the R&D credit offset the taxes caused by those wages that are being paid. So again, it's not planning in a vacuum of one planning tool versus another. It's really using everything that's at our disposal to give you the best bang for the buck. And again, my final bullet point there again talks about there are going to be potentially higher costs to pass-through entities if this net investment income tax provision goes through. You know, is this the long, slow death of the S corporation? Will we see a movement to C corporation? Maybe, maybe not, but I think our message is, regardless of which way it goes, the R&D tax credit is a tried and true method. It's not a one-time benefit. It's a benefit that you can get each and every year. So with that, we're going to go into our final polling question, and this will kind of lead into some of Jen's final comments. Just curious of our audience, how many of you have taken advantage of the employee retention tax credit?
Alrighty, that poll is launched. And this is your third reminder that we needed you to answer these poll questions for that CPE this afternoon. And as always, we'll rate for 85% participation in order to move on. And we're already at 79%, so we're almost there. Just need a few more clicks of participation. Alrighty, 86% has voted, so I'm going to go ahead and close and share the results. And it looks like 67% say no, they have not taken advantage of the ERTC, and 33% say yes, they have.
Okay, well, thanks, Kaylee. Interesting again, about 2/3 have not, 1/3 have. I would encourage you, if you haven't delved into the ERTC, take a look at it. It's obviously beyond the scope of the time we have today, but if you go to the on-demand page of the Stanbaugh Ness website, we've done numerous webinars on it. It's a very powerful credit. You can qualify both by revenue drop or if you were subject to some of the government shutdowns. The reason we ask it today is, as I alluded to earlier, it does have some impact on your R&D credit. So with that, I will hand it over to Jen to kind of take us home here today.
All right. Thank you, Tom. So I am just going to, in the final few minutes here, just kind of the wrap up and just talk about a few miscellaneous provisions related to the R&D tax credit and bring it all together so we can conclude. So a couple things we wanted you to keep in mind regarding our R&D tax credit. Remember that what we've been talking about here so far has been the federal R&D tax credit. So that's the credit taken on the federal return, whether it's your C corporation tax return, 1120S, or individual return passing through to the individual, or the partnership return. But remember, most states do have some form of state R&D tax credit. We do take a look at those when we're calculating the credits, see where the people work, where the projects are located, see whatever states have those credits available. Another thing that you'll want to keep in mind when it comes to the R&D tax credit is the interaction with the employee retention tax credit and other COVID provisions. So I think Tom really kind of nailed this earlier, but you could potentially see a lower credit in 2021, you know, based on either if you took advantage of the employee retention tax credit and you're lowering some of your wages for 2021 to be utilized in that credit calculation. Also, if you qualified for PPP and ERTC and a couple things, you might have had a revenue drop, so you might have had a wage drop as well. So there are reasons and explanations for why your credit might be lower in 2021. But remember, if you are using the alternative simplified tax credit moving forward, you actually are helping yourself. Yes, you might have a lower credit in the current year for 2021, but moving forward, you'll have that lower base period year, and your credit should increase. And then just a reminder, PPP does not impact R&D. Something we just keep mentioning and want to mention, this was considered Section 174 amortization. So in the past, the mechanics of the credit are that it's taken on the return, and if you take the reduced credit, there's no add back. If you take the gross credit, you just add back the credit amount to your taxable income, but that's it. So proposals as part of, even way back to Trump's Tax Cuts and Jobs Act, put something into place where saying that starting in 2022, we would have to amortize R&D costs over 5 years. So any of the costs utilized in the calculation of the credit would have to be amortized over 5 years, not currently deducted, only the 1 year. But that has been, I believe, it keeps going back and forth, but talks are that might be pushed out. It might not be, but remember that is out there. And from what we understand, that was put into the Tax Cuts and Jobs Act as a revenue maker, but never really intended to happen in the future. So it remains to be seen what happens there. But hopefully that will be taken away for the future. Again, it doesn't impact 2021. And then we are always on the lookout for bipartisan support and support just in general for the R&D credit. And by all means, we keep seeing that, especially the passing of the infrastructure bill, the passing of clean energy, all of those types of things point to the fact that the R&D credit, the momentum to keep it in the U.S. is strong and remains high on the list of the powers that be in Washington. So those are some things to keep in mind, and then a few things that you might want to beware of, things of which you want to beware. So dated September 17th and released October 15th of this year was a Chief Counsel memorandum from the IRS, basically stating that all refund claims are going to be, all research credit refund claims are going to be subject to a higher level of documentation. People have until January 10th of 2022 to get that documentation in place. At first, when everybody read this, they assumed that meant all R&D credits, but what we're finding and how most people are interpreting it is that those are for amended returns and not currently filed returns. It's just a much higher level of documentation, and quite honestly, there's quite a few concerns with what's in there. Quite a big outcry from companies in the private sector, really saying there's no way we can do this. So I would expect to see some pushback on this in the future. And then we always like to bring up a few court cases towards the end. Some recent ones that happened over the past year have actually been a little taxpayer unfriendly. While they deal with, there was Tango versus the Commissioner, which dealt with retaining substantial rights, and that's where we're dealing with contract language. And we always talk about contract language when we're reviewing contracts, and we have people tell us, well, that's not what we meant. Well, this proves that the IRS looks to the letter of the law for the contract language. We had Meyer, Borgman, and Johnson. That was about funded research as well. Research that was contingent upon the success of the research. Little Sandy Coal Company was denied because of the 80% experimentation test. And then there have been some procedural cases where the IRS is looking to disallow credits just based on procedures followed. And then finally, there was one back in March of 21, Max versus the Commissioner. That was a clothing designer. And to me, that one was pretty interesting because it was basically attacking the part that a lot of people say is easy to satisfy, a process of experimentation. The step where we're experimenting. They pretty much threw it out and said that this was a clothing designer. It was non-technical, and their process of experimentation didn't matter. So why am I telling you about these? It's not to scare anybody. It's just to tell you that the IRS is paying attention to the research credit. And with the change in laws a few years ago, there's been an explosion of providers out there providing the R&D tax credit. And a lot of them are probably not focusing on the keeping up with the court cases like we are, keeping up with the rules and policies and procedures related to these. So it just always, please remember to use a reputable provider, somebody who you can trust to do the right thing, not push the envelope way too far. Obviously, we're always out there for you and to get you the best result, but not at the expense of pushing an envelope too far and going against guidance and precedent already set. So with that, I think we're going to finish up for today. Thank you so much for joining us. Please remember to fill out the evaluation that follows this. It's very helpful to us for creating future webinars and just letting us know how we did. We do not have time to answer the questions today, but we will respond to those questions and get those back to you. We will be sending out an email to everybody with the answers to the questions in the chat. And then finally, we have a picture up of our team back here, so please reach out to us if you have any questions. Thank you so much.